Thank you all for coming. This is great. It's nice to see a pretty good crowd here tonight. I really enjoy talking about this topic because I know it can truly, change and impact people's lives in a positive way if you really do this. So I hope you leave tonight excited about your financial future. And so we'll go ahead and get started. So the first thing I was going to mention is that you really need to consider taking control of your future. Because if you look at the current debt, which is around $34 trillion right now, and then if you look at the unfunded debts that the government has, and Social Security has some problems because the surplus fund for Social Security is depleting. And if changes are not made to Social Security, everyone will get a 23% pay cut, even those currently getting Social Security right now. Okay, and that's by 2033. Everybody would get a 23% pay cut. So there's going to have to be fixes to Social Security, and you probably won't like those fixes. They could raise payroll taxes. They could raise the retirement age. Right now, for many of you, the full retirement age is age 67. Okay, if they raise that, I'm sure nobody wants to be working into their 70s to hit the full retirement age. If you take Social Security before that, of course, you get a reduced amount. So, and at its design, Social Security is only designed to replace about 1/3 of your income. Okay, so it's not a retirement plan. It's designed to supplement your retirement. So you really need to take care of your own future security, and you need to start doing that right now, okay, because you need to supplement what you're going to get from Social Security. It's not enough to live on, okay, and especially in most places in the country. So we need to start learning how to do this ourselves and secure your own future. So this is from the Federal Reserve. This is a 3-year study. It just came out last fall. This is the median retirement of people in America right now. Now, you'll notice even people near or in retirement have about the median number. That means half of the people have less than this, only have around $200,000 for their retirement. If you think about that, there's a kind of a general rule of thumb that you can withdraw about 4% of your portfolio per year if you want it to last 25 or 30 years, which is, retirement. In fact, if a married couple has made it to the age of 65, there's about a 60% chance that one of you will live till 90. So you need to plan for a fairly long retirement. And the 4% rule, if you only have $200,000 and you take 4%, that's only $8,000 a year. Okay, so these numbers are kind of dismal. Okay, we need to try and do better than this. And that's what we want to take a look at today, is how you can improve your financial future. Okay, so we want to make sure that you're investing in the best assets. Okay, because the rate of return is important. A lot of people feel like silver or gold or something like that is safe. Okay, we see the advertisements on TV all the time, people promoting that. Well, if you look at, over a 10-year period, this is the last 10 years, silver has a compounded annual growth rate of 1.78%. So a $10,000 investment 10 years ago would be worth $11,929 today. Gold has a 5.39% compounded annual growth rate over the last 10 years. So it would have grown into close to $17,000. Median home price. Now, some people think in the last couple of years, home prices have shot up. But in the last 10 years, home prices have actually gone up 4%. Bonds, a lot of people feel bonds are safe. Okay? in the last 10 years, they've averaged 1.8% rate of return. The S&P 500, okay, basically a broad swath of the stock market, has averaged 12.07% rate of return for the last 10 years. Okay, so that's the last 10 years, though. How about the last 30 years? Well, silver did a little better, 5.14% rate of return. So $10,000 over 30 years in silver would have grown into almost $45,000. Gold, okay, did a little better, would have grown into $52,000. Home prices still average 4%, okay, $32,000. Bonds did a little better, 3.94%. But look at the S&P 500, look at stocks, 10.16%. A $10,000 investment 30 years ago would have grown into $182,000. Okay, so what we invest in really matters. Okay, a lot of people are overly diversified. And when you overly diversify, you're putting a drag on your returns because other assets don't do as well. Okay? Now, here's another study. Those were my figures. That was actually using real figures, though. But here's a study by BlackRock, the largest asset manager in the world. Okay? Last 10 years. They did a study of all different kinds of assets. Look at the last column there. That's up to date today, so 10 years ago from today. U.S. equities. Equities is stocks, again, U.S. stock market. Averaged 12.6% rate of return over the last 10 years. Japan equities came in number 2 at 6.6. Infrastructure, REITs, that's real estate, okay, 4.7. High yield, you see high yield there at 3.4. That's really high yield bonds. Those are really what's high yield bonds are classified as junk bonds. Okay, they come with higher risk. Okay. So then you see like cash that's like government securities and things like that. Notice again, whether it's REITs like for real estate or something, nothing really ever competes with stocks. Okay. So let's look at the S&P 500. Here's a chart of the S&P 500 going back to 1993. And as you can see, if you remember back from like an algebra class, this is like an exponential curve. It's not a nice smooth curve, but it is an exponential curve. It's just not smooth. There's years it goes up, years it goes down. But in general, it goes up as we go left to right. Okay, so you can see here, this was considered like the dot-com bubble right there in the early 2000s. Here's the housing crisis. Okay, here's where we are right now. In fact, when everybody was panicking in 2008 and the stock market was at its low, we're up over 500% since then. Okay, if people would have just not panicked and kept investing through that period of time. Okay, so what is the S&P 500? Well, it's basically just the largest 500 companies in the United States. Now, not all 500 companies are, of course, the same size. These are the 10 largest companies in the United States. Microsoft is currently the largest company in the world. So when you invest into the S&P 500 through a ETF, they don't divide up your investment equally between all 500 companies. The bigger the company is, the more in your investment it gets. So 7.25% of your investment goes into Microsoft. 6.62% goes into Apple. And NVIDIA, that's the largest, that's the chip company that's making all the AI chips currently. Then we have Amazon, Meta, that's Facebook. Alphabet is the actual name for Google. Okay? They have 2 classes of shares, so it's listed twice. Berkshire Hathaway, that's Warren Buffett's company. Tesla and Broadcom. Those are currently the 10 biggest companies. Okay, so they get the majority of the money. and then it decreases as we go down. Okay? So essentially, when you're investing in the S&P 500, you're investing in the U.S. economy. Pretty much every company you know is in there. So you're investing into everything. It's automatically diversified. Okay? You own banks, you own healthcare, you own tech. In fact, you can see over there 34% of the money goes into technology companies, 15% goes into financial companies, consumer services, healthcare. In fact, there's 11 different sectors it goes into. Okay, so it's well diversified automatically. Now, how is it done? Well, over a short period of time, and when you're investing, 5 years is a pretty short period of time. 88% of the time in a 5-year period, you're going to make money. Okay? Naturally, if you would have invested in 2007, right before the big housing crisis, okay, it took about 5 years for it to fully recover. Okay, so there is a chance, a small chance, that in 5 years, okay, you don't make that much. But over 10 years, you have a 94% chance of earning a profit. There has never really been a 20-year period where you've ever lost money. And over a 30-year period, the worst 30-year period that exists is if somebody would have invested right before the Great Depression. And yet, it still would have earned 8.46% compounded annual growth rate. Even if you would have invested right before the Great Depression. In fact, over that same 30-year period, it would have gained over 1,000%, your investment. Okay. So, investing is a long period of time. Okay? Stocks go up, stocks go down. But you got to remember, if you don't invest, let's say some people just maybe want to save money. They feel safe putting in a savings account that maybe doesn't pay much, or in their sock drawer, under their mattress, something like that. You are guaranteed to lose money in that case because of inflation. You're losing money every single year. Long-term inflation rate averages about 3 to 3.5%. Okay, so you must invest to keep up with inflation. Okay, so what are the true gains? The compounded annual growth rate of the S&P 500? In the past 5 years, it's averaged 15.75% rate of return. In the last 10 years, a little over 12%. In the last 20 years, 9.69%. 30 years, a little over 10. In the last 40 years, it's averaged over 11%. Those are remarkable returns. Okay? And it's so simple to do. The beauty of the S&P 500 really is you don't have to know anything. You can just invest in the S&P 500. You don't have to decide which stocks to buy. What's the best investment? When you invest in an ETF for the S&P 500, you are just buying a piece of 500 companies. And you can see over the number of years, the rates of return are remarkable. That might be why even Warren Buffett says that individual investors should not go to a financial advisor. He says an individual investor would be better off just buying a low-cost ETF for the S&P 500. In fact, in his will, when he passes away, his will states that the cash that he leaves his wife, which is a little younger than he is, 90% of it is to be invested into an ETF for the S&P 500 and 10% in government securities, something safe, cash for ready use. Nothing sophisticated, no fancy advisors, because he knows it's important to avoid fees, and this is a great investment. It's very easy to do. You don't have to know anything about stocks. Now, what about professionals that give advice? Well, Here are the financial firms' predictions going into 2023. We see we have Barclays, Morgan Stanley, UBS, Citigroup, BlackRock, Bank of America. Here's what they predicted the S&P 500 would do in 2023, that last column. They thought 2023, these are, the biggest financial firms and the professionals running them. This was their prediction for last year. You know what the S&P 500 actually did? It went up 26%. Professionals cannot predict the market any better than you and I can. Okay. Which is one thing you want to remember is you want to tune out the news, you want to tune out the professionals, the pundits on TV that are always giving advice, selling fear and panic, or selling euphoria or something. All of that is noise. An investor really doesn't care what the market is going to do in any particular day, week, or even over the next year or two. And investing is more of a long-term endeavor. So you want to be careful listening to professionals. In fact, this is what's called a SPIVA report. It's put out twice a year, and it's a comprehensive, detailed report where they look at how professionally managed mutual funds did against their S&P benchmarks. In other words, can they beat the market? Professionals running mutual funds. Now, I want you to look here. Over 10 years, 15 years, and over a 20-year period, 90 to 95% of professionally managed mutual funds do worse. And this is consistent. This is the most recent one from the end of last year, but I don't care what year you pull up, whether it's last year, 5 years ago, 10 years ago, this is very consistent. Professionals cannot beat the market over a long period of time. Anybody can get lucky for a few years. You can see over a 3-year period, roughly maybe 2/3 of them do worse. Okay. But once you get into a little bit longer, this is the percentage of people, professionals that do worse than their S&P benchmarks. So think about that. These are the people that people are paying fees to go get their advice. You could have just bought the S&P 500 and you would have been better than 90% of professionals with zero fees. Okay, so here's an interesting concept too, because professionals aren't very good at beating the market, but individuals aren't either, because we're emotional. And you're not very good at predicting or deciding what's a good investment. So this first chart is an idea that everybody would love. What we're doing here is you're making a $6,000 investment, let's say into a Roth IRA or something, a retirement fund, per year. This is hypothetical, but let's say in year one, right here, this one here, if it was $80 a share, you would get to buy 75 shares. In year two, investing $6,000, okay, it went up to $100 a share. But at $100, you only get to buy 60 shares. The next year, it jumps again to $120 a share. You're feeling great about yourself. You feel like you're smart. Because every time you buy something, it goes up in value. But at $120 a share, you only get to buy 50 shares. Then it goes up again to $125. Then you only get to buy 48 shares, though. The next year, it stays there. And then the last year, it jumps again to $150 a share. You started at $80 and now it's worth $150. Every single year, every time you bought something, it went up in value. This is the kind of investment that everybody dreams about. It just keeps going straight up. But look at this. If you add up all these shares, there's 321 of them. If you multiply that times the share price of 150, your investment now is worth $48,150. Now, what about this person? Started at the same amount, $80 a share. In year 2, it drops to $60. They're probably a bit fearful now. They're probably not even very happy. They made an investment, they invested $6,000 and it went down in value. Okay? Then it goes down again. Okay? They're probably not very happy at all. They might have quit by this time. They're thinking, this isn't for me. But look at that. At that price, you get to buy 120 shares. And then it drops again. But you get to buy 150 shares because they're less. They're not as high priced. And then it slightly goes up. And then in the year 6, it finally gets back to where you started. All that time and all you did was get back to where you started. But that's a better investment. Because if you add up these shares, there's 640 of them. And they're only worth $80 a share. But you have more money than that one. Now, I bet if you didn't see those numbers and you just looked at those graphs, I bet everybody would have picked that investment. This is a concept that you need to remember, because when the market is bad, or when a lot of people feel it's bad, that is your best opportunity. You get to buy things when it's on sale for a while. I bet if you were out clothes shopping or something, you like sales. Okay? So why not like the stock market when it's on sale? It's a wonderful opportunity. Back when 2008 was happening and everybody was fearful, a lot of people started seeing their investments go down. Some people eventually just couldn't take it anymore, and they thought, I just got to sell whatever I got left. So a lot of times people sell towards the bottom. Then they're fearful to get back in, and they miss the ride back up. If they would have just kept investing every single month, that was a wonderful opportunity. In fact, in 2020, in March, a lot of stuff was happening, right? The stock market, the S&P 500, in a 4-week period dropped 34%. Pundits and people were coming on TV all the time, selling fear and panic. In 4 weeks, it dropped 34%. But you know what the stock market did, the S&P 500 did for the entire year of 2020? From January 1st to the end of December, it was up over 18%. That was a wonderful opportunity. So, when the market's down, you should remember this. When the market's crappy, you should be happy. Okay? Things are on sale. It's your best time to be investing. What you got to remember is those 10, 15, 20, 30-year periods of what the S&P 500 does over a long period of time. You need to have confidence that it's going to average a compounded annual growth rate of around 10%. And when it's going through a bad period, that's your greatest opportunities. Okay, now, the other thing is, another reason why you never want to get out of the market. A lot of people think, well, I'll sell, and when it's over, going down, I'll get back in. The problem is you never know when to get back in. And you miss just a few days, and you severely hurt your returns. So this is an investment, a $10,000 investment over a 20-year period from January 2003 to December of 2022. If you would have stayed fully invested, it would have grown into about $65,000. Missing the 10 best days. it only would have grown into $29,000. Missing the 20 best days. Okay, you have to stay fully invested. Sometimes, in some years, the market is down. But you need to stay fully invested. And remember, if you're going through a bad period, just keep investing every month. You're buying stuff when it's on sale. It's going to help you in the long run. Okay. Those best days happen usually right after a bad period. And if you get out, you're going to miss those. Okay, so I want to go for some examples to show you how easy this can be to create financial freedom and control over your life. So think about this. If somebody was making $50,000 a year, we'll just keep this consistent, no pay increases in this example, for 45 years, their total lifetime earnings would have been $2.25 million. Now, that isn't all theirs, because you got to pay Social Security, Medicare tax, you got to pay income tax, okay? And that's not take-home pay. Part of that's the government's. But that's your total gross earnings. Now, imagine if you would have just saved $300 a month, which is only 7.2% of your income. So for every dollar you made, you decided to save a little over 7 cents. Okay, so if you would have, again, this is over a working career of 45 years, 10% rate of return, that's what the S&P 500 has always averaged. It would have grown into $2.7 million. Notice, that's more money than you even made over your entire working career. If you get started early in life, okay, if you have that luxury, just saving about 7 or 8 cents of every dollar you make will grow into more money than you even earn over your entire lifetime. That's incredible. That's the power of compounding growth. Now, remember that figure? $2.7 million. Remember, you can buy the S&P 500 with no management fees. What if you were paying just a 1.5% management fee? Let's say we go to, we're paying advisory fees and we're using mutual funds and they charge fees. So let's say we're paying a 1.5% management fee. So instead of earning 10%, by the way, remember over 90% of mutual funds do worse than the S&P 500. So this is assuming they do as well, but you're paying a 1.5% management fee. So instead of earning that 10, now you're only earning 8.5. So let's see what happens to that $2.7 million that you would have had. Now you have about $1.7 million. Paying a 1.5% management fee cost you $1 million. 1.5% doesn't sound like very much. You're thinking, oh gosh, I don't mind paying 1.5%, because I don't want to have to deal with it. It's incredibly high. In this example, it just cost you $1 million. Okay, now, naturally, things don't remain the same. We get pay increases, inflation happens, and things like that. So let's take a look at more of a actual calculation here. This is somebody starting at only $50,000 a year. By the way, the median income in the United States right now, the median income is around $74,000. So we're only using 50. Okay. So $50,000 with a 2% annual increase for 45 years. So you get a 2% pay increase every year. Your total lifetime earnings, you can see, would have been about close to $3.6 million in total gross earnings. Remember, that's not all yours. You got to pay taxes and stuff. Now, what if you would have been saving 10% of your salary? putting it into the SP 500. It would have grown into $4.4 million. Again, far more money than you even made in gross earnings. That's if you don't pay management fees, though. What about if you would have been paying that 1.5% management fee? Now, notice if you didn't know you could have had 4.4, and if somebody said, yeah, if you do this, you'll have 1 or 2.8 million, you're thinking, wow, that sounds great. But you don't know what you could have had if you would have avoided the fees. Fees are incredibly important when it comes to investing. Very, very important. Okay, so how about savings to reach $3 million? Just nice round number. Okay, it can be less than that, but here's why every year counts. As soon as you can get started, the better. Now, some of you can't get started when you're 22, and that's fine too. But notice if somebody does start right out of college at age 22, again, this is for somebody that only has a salary starting out at $50,000 a year. Saving just 6.5% of their salary. This is starting at $50,000 with a 2% pay increase every year. So notice they only had to save about $271 a month. They would end up at $3 million. Even though, notice over their entire working career, they only saved about $233,000 of their own money. That's it. And it grew into $3 million. That's the power of time and compounding. Now, if somebody waited to the age of 30 to get started, well, now they got to make a few more sacrifices. They got to save around 12% of their salary, or about $600 a month, and they could still reach the $3 million mark. They would have saved about $390,000 of their own money. At 35, if you wait until then, well, notice you got to save 18.5% of your salary, or almost $1,000 a month. Now, maybe somebody's 35, they can't quite do $1,000 a month, but you could do half of that, then you'd end up with $1.5 million. Okay? If you start at the age of 40, you got to make more of a sacrifice. You got to save about 28% of your salary, and at 45, 44% of your salary. Okay, so every year counts. The earlier you can start, the better. Okay, but every year counts. Now, I want to go back to the idea of when the market's crappy, you should be happy. So I'm highlighting this. This is a zoomed in chart that starts at the end of 1986 and just goes up to the beginning of 1988. This little drop right here, this is the single biggest drop ever in one day in the stock market. Happened in October of 1987. The largest drop, single day drop ever. Okay. That can cause fear and panic, just like March did in 2020. But here's a zoomed out picture of the SP 500. You see this little spot right here? There it is. Right there. It's pretty insignificant. It's a non-event. And that's what every crash is like to an investor, or it should be anyway. Those are really, you should look at those as opportunities to invest. Scrape together a little extra, invest a little bit more every month during the bad times. Because right here is 2008. In a few more years, it's going to look like this. It's going to be a non-event. And think of all the fear and panic that was happening in 2008. If people would have just tuned out the news, which likes to sell fear and panic, and just kept investing, you would have made so much more money, because that was a wonderful opportunity to be investing. Look where we are now. So, with investing, there should never, it's easy to say, I understand, but there should never be any emotions when it comes to investing. And that's easy to say when the market's going down, to not be emotional. But if you can remember some of these things from tonight, those are wonderful opportunities. In fact, investing done right is not exciting either. In fact, it's rather boring. It's just something you do. It's a habit that you incorporate into your life. You do it all the time, every month. It's not exciting. It's not trading. It's not speculating. Okay? You have confidence in what it does over a long period of time, and when the bad times come, you should be happy. Okay, so let's close with some tips. First of all, you have to visualize the life you want. You have to know why you want to have financial freedom in your life. If the only reason you want money is so you can buy things, you're probably never going to do this. You're probably never going to achieve financial freedom and control over your life. You want to invest for the idea of having freedom and control over your life, where working is your choice. So knowing why you want to create some wealth is really important. You need to start as soon as possible. Okay? Some of you might feel like you've missed that opportunity to start when you're in your 20s. But every year does count. And even if you're in your 40s or 50s or approaching 60 or something, okay? Social Security is not enough to live on. So whatever you can do before you retire is going to help. Everything is better than nothing. Stop finding reasons to procrastinate. Create a budget. Most people have no idea where all their money goes. If you really, I know budgeting is boring, but at least do it for a couple months and track where every dollar goes, and you might be surprised what you're spending on stuff. And that will allow you to find some areas where you can probably save a little more. Remember that if you find areas to cut back, money saved is worth more than money that you earn, because you've already paid all the taxes. Your take-home pay, you've already paid all the taxes. Okay, if I go out and I spend $100, to replace that $100, I might have to earn $130. So then after taxes, I have $100 left. Okay, so finding areas to save is really important. Don't spend first, save first. Here the idea is, I will guarantee you, if you, like many people do, if you go through your month and then you tell yourself, I'll save whatever's left at the end. I'll pay all my bills and whatever I got left at the end of the month, that's what I'm going to save and invest with. If that's your attitude, you'll never do this. Because money seems to always go someplace. It's got to be their first priority, the first thing that comes out of your paycheck. And then you find a way to live on what's left without going into debt or credit card debt. It's got to be a priority. It's the first thing out of your budget. And then live within your means on what's left. Okay? It has to be a habit. Build a strong credit score. People underestimate how important this is. Your car insurance will be dramatically cheaper with a high credit score. Your house insurance will be dramatically cheaper. You'll get the best interest rates if you do have to borrow money for a car or on a mortgage or something. Okay, so A credit score actually saves you a great deal of money in life. Build an emergency fund. Okay? Everybody should have an emergency fund for those unexpected things in life that come up, and they always will. Because an emergency fund protects you from falling into debt, like credit card debt. When something unexpected happens and you don't have an emergency fund, that's how people sometimes end up putting it on a credit card or something like that. So you want to build an emergency fund. You need to value financial freedom and be careful of what's called lifestyle inflation or lifestyle creep. It's very easy to fall into that trap because as we make more money, it's natural to want to improve our life. Maybe buy a little nicer car, nicer house, that kind of stuff. But a lot of times people end up still just living paycheck to paycheck. Right now, it's remarkable how many people are making $150,000 to $200,000 a year in this country that are still living paycheck to paycheck. They've just increased their lifestyle right along with their income, and they're not saving. Okay, so we got to be careful of that. And it's very, very easy to fall into. And sometimes it's things that we don't even think about. Imagine this. Maybe somebody's in their early 20s, or this could be really for anybody at any point in life. And you're thinking, well, things are kind of tight. It's hard to save money. But let's say you're out there shopping for a vehicle. Well, Americans kind of like their vehicles. What if you were looking at a vehicle and it was a $20,000 vehicle? And it would have been sufficient. It would have done everything you needed. But then there's that $30,000 vehicle over here. And you're thinking, that'd really be nice. I'd rather have that one. So you talk yourself into it. You spend an extra $10,000 to enjoy a nicer vehicle. You just made the decision to spend an extra $10,000. Now, over the next 4 or 5 years, you got to, pay off that vehicle. But you just spent an extra $10,000. Plus, your insurance is higher. There's more depreciation. Your taxes are higher. But imagine if you would have taken that $10,000 and invested it. And that's just for one car purchase. And people buy multiple cars throughout their life. So we choose, a lot of times, to spend that extra money rather than invest it. If investing and creating financial freedom is important to you, it's got to be at the forefront of your mind. It's got to be in every decision you make. You can find a way to do this, but it's got to be a priority. Opt for a discount broker. Okay? Remember, we looked at how important fees were. You can set up an account at a place like Fidelity, Schwab, Vanguard. Doesn't cost a thing. You can buy the S&P 500 with no brokerage fees. And the fees are actually, there's what's called a little expense ratio. It's 0.03% on many of them, 0.02%. That's 0.0003. It's so insignificant, it doesn't even really matter. So you need to avoid the fees. Really important. If you have access, if you work someplace that has like a 401k, you need to take advantage of that. You need to do it. And the most efficient way to do this, you can put $23,000 into a 401k, and that's without the employer match. But if you can invest more, than just enough to get their match, there's a little bit better way to do that. So 401ks, because they're offered through your employer and they farm them out to a firm that manages that, they come with slightly higher management fees. But if your employer matches what you put in, and most all of them do up to a certain amount, you're doubling your money the very first day. So it's a wonderful opportunity. You want to do enough in your 401k to get the full match. Absolutely. Okay? Get all the money that they're going to put in. And then, if you can invest more than that, then you're actually better off switching to a Roth IRA. Because an IRA can be set up at like Fidelity or Schwab or whatever, and you can invest with no management fees. Again, we just looked at how important management fees were. So you can dump $7,000 into an IRA. And if you're over 50, you can put an extra $1,000 into an IRA, as long as your income isn't too high. Really high income earners can't do that. But consider an ETF for the SP 500. A passive investment just means that there's not a manager. You don't want to be paying a manager. 90% of them do worse. Okay, so you would switch back to the Roth IRA and you want to max that out. So do your 401k enough to get the full match. Get all your employer's money you can. And then max out your IRA. Now, a Roth IRA, the beauty of a Roth IRA is the amount that goes in is you use your take-home pay. You've already paid taxes on that. But do you remember those huge amounts of money we saw at the end when we had 2.7 million, 3.4 million, or whatever? That huge balance at the end that we looked at in our examples, that entire amount is income tax-free if it's in a Roth IRA. It doesn't matter whether you pull out $50,000 in 1 year or $400,000 in 1 year. It's all tax-free. And with the amount of debt that the government has, I feel rather confident that years down the road, income taxes are probably going to be a little higher on everybody. So having a Roth account protects you from potential higher income taxes. Now, if you've done enough to your 401k that you get the full employer's match, and then you've maxed out your IRA, and then if you can still invest more, go back to the 401k and continue contributing there. Okay, so remember, you want to embrace market volatility. By the way, everything goes up and down, even gold and silver and all that stuff. Okay, 10 years ago, gold dropped 30% in a matter of a couple of years. Okay, so all of that stuff goes up and down. We just don't look at that all the time. The stock market gets reported in the news every day. Okay, so remember, you want to embrace volatility. When the market's bad, just be happy and keep investing. It's your best opportunities. If you do this, at some point, there's going to be a nice lump sum of money sitting there in your retirement accounts. For a lot of people, that's very, very tempting. Because you could pull it out and buy yourself a new car or whatever. And people do that all the time. There's a lot of people working at Walmart right out here that do their 401k. And every 6 months to a year, they empty it out to pay bills or do something. Remember, time is important. You can't get back time. So you have to review those retirement accounts. You have to view it as off limits. Don't use it. Okay? View it off limits. That's your future security. And of course, we can't cover everything in one talk, in one evening. Okay? There's lots of things. But right now, this is from a government study that, government spends a lot of money on studies. Currently, right now, Americans are spending 4.5 hours a day on their phone. And most of that isn't useful time. Imagine if you just spent a little bit of time learning more about this stuff. You could truly change your life. So you want to continue after tonight to expand your knowledge. Keep learning about this stuff. Make it a priority. Now, I guess with that, I do have a YouTube channel. So you're welcome to check stuff out there. And there's a lot of topics covered here, like the difference between traditional IRAs, Roth IRAs, different types of investing, rent versus buying a house and things like that. All different kinds of topics. There's a lot more videos in this. By the way, an HSA is, if it's used properly, that's a health savings account. If used properly, that's actually the best retirement account. Because the money goes in, you don't pay any income tax on it. In fact, if it's done through an employer, you don't even pay Social Security and Medicare. And then you can invest it, like in the SP 500. You can set up an HSA, you can set one up at Fidelity too. And then you can invest it, it grows. And when you pull it out, it's also income tax free. You don't pay any income tax going in, you don't pay any income tax going out, and all the growth and all that is free. It's actually better than a traditional IRA, it's better than a Roth IRA. It's the only account that is like that. And you can use it for a retirement account if you use it properly. And you can put, currently right now, $4,150 into that every year. If you're over 50, you can put an extra $1,000. So there's a lot of things that you can do that can really, really benefit your future. Okay. All right, well, thank you all for coming. I hope you found it valuable.